wasn't the one talking to that particular buyer, but he sends in what's called an indication of interest, which is not an offer, but it says, this is what I think I'm going to pay.
Mm-hmm.
Often it's a range. This was an exact number, and it was way off the mark. And do I share it with my client? I said, we got it. We had someone do this indication of interest. Here's the amount. Do you want to see it? They said no.
Mm-hmm.
If they said, I want to see it, we show it to them.
Mm-hmm.
But we want to keep that emotion off to the side for them, that we can handle that as much as possible.
Welcome to the Value Factory Podcast, brought to you by OneAccord. We're all about helping businesses thrive and grow through leadership, strategy, and meaningful impact. Now, whether you're a seasoned executive or just starting out, our goal is to provide insights and inspiration to help you navigate your journey. Thanks for tuning in.
All right. Welcome back to the Value Factory. I am pleased to be joined today by my friend John Martinka with Nokomis Advisory Services. Now, John and I, we've known each other for a couple of years directly, but I'd say even longer indirectly. I knew of John and his firm from my years in banking,
right,
as being advisors to those wanting to sell companies or wanting to buy companies. Over the years, you've done a lot of work in that M&A advisory space. Maybe let's just start out and tell us what you're up to now, what your current focus is. But our conversation is going to be really focused on what owners need to be considering in times of uncertainty, because there are always times of uncertainty. But before we do that, what are you guys focused on these days?
Well, what we're focused on is really trying to help owners exit. And Jessica, my daughter, our latest book is called Exit with Style, Grace, and More Money. And we are looking at the lower middle market. We do where we have a target of 5 to 15, 20 in enterprise value. We don't want to compete and do what the business brokers are doing, and we don't want to compete with the investment banks. They can be good referral sources for us.
You said a few things in there that I'm sure many people listening would understand pretty quickly. But let's break it down. You said 5 to 10 to 15 in enterprise value. So that's 5 million to 15 million.
About 5 to 15 would be the real target. But
okay.
Look, I'll be right to the point is, we'll do something a little bigger we have. But we really target that 5 to $15 million value range. And anyone in my industry who says, well, we don't go below a certain amount, we'll go below that. And we have, if it's a great referral source and a really super client.
And to get to, so in the middle of that range from 5 to 15 is 10 million enterprise value.
Yeah.
What makes a company worth 10 million bucks?
Well, it really is, first of all, tied to their profit, their free cash flow. What do they have left after they pay for everything?
So it's not just sales. Company has 10 million in sales. It's not going to make them worth 10 million bucks necessarily.
No, it could be more or less. Now, we are not talking SaaS businesses, software as a service, which have outrageous valuations, but we are talking operating businesses, the kind your people like to go in and help with, manufacturing, distribution, service, those kind of things. But it's not just the earnings, because you could take two businesses and let's just say for round numbers, they're both making $2 million a year after paying everything, including owner's salary.
Mm-hmm.
And you say, well, are they both worth 10 million? Well, maybe. Mm-hmm. What if one of them has two customers that are 69% of their business and the other has 69 customers or 69%?
Yeah.
There's a lot more risk in that first scenario, and people won't pay as much for it, or will have it tied to a factor like those key customers staying for a certain number of years.
Yeah.
It could be one company has a 5-person management team and are all 65 to 73 years old, versus the other one where they're in their 40s and 50s. All of those things come into play.
Excellent. Thanks for breaking that down. So you're working primarily with the sellers of companies to
The owners.
Thank you. The owners of companies that want to sell, as compared to folks that want to buy businesses.
We do that, but it's something that's on the back burner. Even though, we have a great reputation in helping buyers.
Yeah.
My daughter really said, "I want to work with sellers," so we're trying to grow that even more.
Yeah.
And we've done good, and I feel really fortunate. The deals we've had recently have been really good, honest clients.
Yeah.
That's number one, right? You got to have a good client.
Yeah. And how long have you been in this business?
I've been in this business since the late 90s.
Okay.
Yeah.
So that's about 30 years.
About 30 years.
Yeah.
Yeah.
All right. So you've seen a few things.
Seen a few things, seen a few changes. The old line, "This too will pass," for whatever we're going through, good or bad.
Yeah.
There's short-term disruptions, and your people see it all the time, Nick.
Yeah.
When they're working with companies,
Yeah.
a company says, we want to grow at 10% a year. It doesn't grow at 10% a year. It goes up more, down a little. You buy a new piece of equipment, you got to get used to it. The profit may go down a little, but then it becomes efficient.
Yep. One other thing you said as you were introducing yourself, your latest book, Exit with Style, Grace, and More Money.
And more money.
And more money. All right. All three of those things are important.
They
Style and grace, and obviously getting the maximum value out of the asset that someone has created or stewarded.
Right.
Yeah.
Or close to the maximum value. Because
Mhm.
I'll tell you, I've seen so many deals over the years. In fact, I just talked to a friend, and he bought a company, and he said, "I was the lowest bidder, but he was the fit."
Yeah.
He was the person they wanted.
Such a good point. There are owners that we work with. Now, we don't sell companies. That's what you and Jessica would do. But we work with the companies as they get ready for. You mentioned 2 companies, $2 million bottom line each. One of them has 69% of their sales and 2 customers, and the other has 69 customers that represent. So we help to solve those problems, reduce the risk, of course. In working with those owners, so many times it's within the context of what do you want to see when you exit this company? Well, I want to get paid, and I want to take care of my people, and I want the legacy of this company to be stewarded by the next person. It's not just a financial objective.
That is at least 80% of the time. That's the 80-20 rule, and you hit the 3-legged stool.
Yeah.
Yeah.
Really good. Okay. You said your latest book. How many books have you written?
5.
That's awesome.
On business buying, getting the deal done, so on getting it ready for sale, and growth by acquisition are the subjects. Now, you just said you don't sell companies. We don't do that work to get them to the point where they should be to get the value they want.
Well, 30 years in the business, you've worked with who knows how many, how many, but many, many owners, many companies. And I'm sure you get asked all the time, what can I do to make this sale smoother, get more money, affect the transaction? And you probably know from your experience. And then I imagine people say, can you help me do that?
They sometimes do. And we don't do that.
Yeah.
And if it's the right size for OneAccord, we would gladly send them to OneAccord. Sometimes they say, tell me what I need to fix in this company in the next year or two, and I have time to do it. That's a different story.
Yeah.
So we can't argue with that. We know what they should do. We can see the warts that a buyer would see. Having worked for buyers, we know what buyers are going to get spooked by and what they're going to get excited by.
So there are things that are within an owner's control. You can observe, hey, you've got excess customer concentration. You've got a leadership team that's between the age of 55 and 72. You probably need to recruit some next generation in there. Those things an owner can control. But then there are things like, in the early months of 2025, the tariff war, that the global trade war that seemed to be taking over. A client that we had advised as they were getting ready to exit. So here's a story from 2024. Called us in. We looked at the business. We said, your key risk, your number one risk is your supply chain. And they were buying things overseas. and this company had difficulty selling in the past. And we said, this is the risk that you need to mitigate. You have to solve for this. You need to onshore, if not all, some of your supply chain. And they elected not to. And they went to market, and they had a great offer. And they pursued this offer. And unfortunately, in the first quarter of 2025, the buyer backed out because of tariff concerns. Now, it's a great company, great product. They will be able to sell, but just not to this buyer and not under those terms and conditions. But, I invested a lot of time and energy in that particular transaction, and they'll, go back to market. Undoubtedly, they'll find a buyer. Great product, great company, but that happened because of an externality, right?
And we're seeing that. We're seeing buyers getting spooked and saying, market conditions, I'm not going to do anything. We're seeing sellers being very cautious because they have worries. They, let's say it's only a little bit affected by tariffs, but that leads to everything else that's going on. Is inflation coming back? Are we going to a recession? And the seller is thinking in many cases, well, if I sell it now, I don't want to get it back. I want to make sure the company lasts, my legacy. I want to make sure the buyer's successful. Maybe I should just wait and see. We've seen a lot of the wait and see on both sides.
In 3 decades of doing this, is that common for times of uncertainty? You get a lot of wait and sees?
It's not uncommon. You go back to, COVID was a completely different thing when they shut down.
Yeah.
Certain states, including where we are, shut everything down. But you go back to the Great Recession, real estate collapse of 2008-9, go back to 9/11, and even the dot-com boom. At least in the smaller business market, where say an executive says, I'm going to leave and get my own business. Why would they leave at that point? When if they wanted something different, they just, it's like a revolving door in a store. They go in one and come out the other side, get more money, more benefits. And then that fell apart. But they all cured themselves.
Yeah. Like you said, this too shall pass. But what should people do? the million or multi-million dollar question.
Yeah. It's hard to say what an individual business owner should do because every business is different and their situation. But it always comes back to if you do the things you're supposed to do, good things will happen. And you just talked about diversifying a supply chain. If it can't be done overnight,
right?
And especially for a small business, even though we call it lower middle market or middle market, they're still small businesses. They don't have the heft of a big conglomerate that can easily move things from China to Vietnam or Vietnam to Mexico. It takes a lot more time in our market, but you have to be prepared for that. And you have, getting an assessment, like if you do an assessment of a business and you point out, here's 5 things that if you do these, you will not only grow, you'll make more money, you'll increase your multiple of those earnings. Because again, some of the warts we talked about, you're going to get a higher multiple if you have customer diversification, if you have an owner who is pretty much can be absent almost all the time and has a team. So that's all those things.
So there's the notion of a multiple. And here again, we're in the trade, we're in the business, we understand. So that company that has $2 million in free cash flow, but 2 of their clients make up 2/3 of their sales. And the same company, same industry, $2 million in free cash flow, but they have fully diversified. They've got hundreds of customers that make up their revenues. It's the risk that you talked about.
It's a risk.
And so a buyer might say, well, I'll pay you 1 times your earnings. I'll pay you $2 million because so much of those sales are concentrated in 2. If one customer leaves, then, but I might pay 5 times earnings for this very well diversified business. So we have one company worth $2 million, another company worth $10 million. because of customer concentration. That could be an extreme example, but
It is extreme. And let's define the multiple of earnings is really the same. It's basically the inverse of the price earnings we see in publicly traded stocks.
mm-hmm.
If any big bank is trading for 10 times earnings,
Mm-hmm.
or price earnings is 10, they have a 10 multiple.
Yeah. So in that extreme scenario, to go from 2 customers to 100 customers, that doesn't happen overnight.
No, that's where you guys come in, and because the multiple, it's just increase the earnings, increase the multiple at the same time.
Mm-hmm.
It's a double hit.
Right.
It's a good double whammy. But let's let's also go look at another scenario.
Yeah.
You got the company with 2 customers, 2/3 of their sales. A buyer may come in and strike a deal that says, I'm going to pay you X, but you can get to where you would be if you were diversified, but only if we get there in a certain amount of time. So it's called an earnout.
Yeah.
And if a seller is so motivated, and motivation is driven by a lot of things, but if there's a catastrophic event, the motivation goes up.
Yeah.
A serious health thing,
Mm-hmm.
tied maybe to a disability, a divorce.
Yeah.
We have to sell. We can't split our assets if we don't sell it.
Yeah.
Then perhaps an earnout is appropriate, whether it's that kind of scenario or not. Just burnout.
Yeah.
Yeah.
I don't even know if I've shared how much of my personal life story I've shared with you, John, but we'll get into it. We're going to have conversations like this regularly. Mm-hmm. This could be fun. There's a season of my life where I went through some pretty big trauma, some loss, real challenge. And I came out of that with a mantra, something I have said many times, which is make time to prepare for a time when there is no time. So I say this to myself. It's really what gets me in the gym. I don't want to go in the gym, but I have to make time to prepare for that time when, I don't know who might ever in their life have to run a 5K, but if I haven't made the time to prepare for it, I'm probably not going to have much time to get ready when the starting gun goes off. Same thing in business. Stuff happens. Life happens. Death, divorce, loss of a key business partner, economic uncertainty. And it can just be time to sell the business. And, my want for all of the entrepreneurs and owners in the world is that they would have made time to prepare for that time, to get out. And in the context of externalities, right? We've talked about COVID. I think we talked about .com. There's the global financial crisis, what we knew in the U.S. as the Great Recession of 2010-ish. For me, that started in 2008 because I worked in banks and I could kind of see the writing on the wall, see it coming. What can an owner do when you just can't prepare for something that specific, but can they prepare for, anything? You said it earlier. If you do the right things, the good things will happen.
Yeah. So here's what it is. And this ties into what OneAccord does. So one of the things I've learned over the years is there are some owners who will wake up one day and say, it's time to start thinking about exiting my business. I've had it for 20 years and I want to raise the dimmer switch. So in 3 years, when I'm ready to go, it's bright and shiny and the buyer's going to love it and they're going to pay me a good price and it's going to be the right buyer for my business.
Mm-hmm.
And all those things they do to get it to that point are the things that prevent them from having a major crisis if something happens.
Yeah.
The spouse gets cancer or kid is hit by a car and they say, I can't do this anymore, but it's up here, versus the owner gets up and say, it's been really grueling, flip the switch, I want out. And then they have all these things that maybe aren't as dramatic as 2/3 of customers or of sales to 2 customers.
Yeah.
But there's all these little things that have added up that buyers are going to say, well, that's a little black mark. I'll pay you 3x, not 4 to 5x
Mm-hmm.
times your earnings.
So if the owner's doing the right things, so looking at customer concentration, looking for diversification, structuring a management team that has succession in mind, there's some longevity, supply chain. What else comes to mind?
Oh, financial statements and accounting systems.
Yeah.
That when someone else looks at them, they make sense.
Yeah.
Because buyers are going to pick them apart more than ever these days.
Yeah. That's not something that we do at OneAccord. So we might look to a partner in the market, CFO selections or Turning Point or others.
Right.
But what I can share from my own experience coming into OneAccord, so I've been here a year and a half. The organization is 25 years old. There's 25 years of financial history that did require some cleanup isn't the right word necessarily, but some reconfiguration, because this company over 25 years had done a lot of different things that show up in financial statements that are different than the way that we're doing business today and we will into the future. That short story, or just the kind of punchline there, I've spent more money with my CPA than I ever thought I would, just working through some of the financial statement reporting. And I'm not in this moment prepping to sell the company, but I am ensuring that financial statements are aligned so that if something between Jeff and I, something may happen. Something may happen in my life or his life, and it just makes, we're prepared.
Yeah,
that way.
But the other big thing, and this is a tough one, is getting the owner to realize the less they do in the business, the greater value they provide.
Mm-hmm.
And I like to tell that, we're in the spring of 2025. About a year ago, I went to an ACG meeting, and it was basically a dialogue discussion of a company's sale process, and the company sold for $70 million.
Mm-hmm.
That's a lot of money.
Mm-hmm.
2 owners, and one that was there said something along the lines of, my partner and I realized during the due diligence process we were way too tied to the day-to-day operations of the business than we should have been. It's a $70 million value company.
Yeah. That's interesting. We're not a $70 million company yet. I wear every hat in the business.
But Nick, you're a quasi startup because OneAccord shifted gears a year and a half ago when you came on.
Yeah.
So it's not necessarily a valid comparison at this time. Now, 3 years or 5 years from now, if you're saying I wear too many hats, and if I'm not here, these things don't happen, you've got a problem. Your people, your consultants could come in and help you with, right?
Yeah. That's the thing. Like we need to take our own medicine here, and I just have so much empathy for my peer business owners, right? Those other folks like me in the market that might be approaching you, and they say, "Well, I want to sell my company," and you say, "Well, you're probably going to have to take a deal with an earnout because you have to be in the company for the next 2 or 3 years through transition." And that person's like, "Well, no, I want out." And it's like, it's not in the cards right now. I have so much empathy for those people because transitioning to it's hard, man, to hire the right people, get them trained up, trust them, let go, see them do it, watch them fail, help them, pick them.
No, it's easier to find them than it is to trust them to do it.
Yeah.
It's just like in in selling a business, people say, well, the buyer, finding a buyer is the easiest. There are buyers everywhere. It's finding a buyer to give you a deal that's
Yeah.
fair to both sides, and especially to the seller.
Yeah.
There's a lot of buyers out there who will pay a lot less than it's worth.
Yep.
That's easy to find them, but good ones.
Good point. Specifically on the topic of, economic uncertainty, something that always happens when, we've said .com, Great Recession, COVID, trade wars in the first, third of 2025. Those economic conditions affect financial markets. They affect interest rates. They affect valuations. So it feels bad when we're in these times of uncertainty, but it also translates to, mathematical challenges as well. For example, if the cost of capital, if it costs me 12% to borrow money to buy a business versus 6% to borrow money to buy a business, that's going to have an impact on the valuation, isn't it?
It shouldn't affect the valuation. It may affect what the price that the buyer will pay and how they will pay it.
There we go.
An appraiser should not be taking financing into account when valuing a business.
So not the valuation, but the actual sales price.
Yeah. And those numbers, those terms get confused all the time.
Good. I saw a very interesting graph of a company taken to market, open bids, and they got a lot of attraction. I think there were 50 bids.
Yeah.
It's a lot. And the range went from 40 million to 105 million. Huge range of what people were willing to pay for this company. And then there was a second round of renegotiation, and some people came up and some people came down, but that bid bracket got tighter and smaller. And then the owners were also looking for the right fit. Did they want to sell to a private equity, or did they want to sell to an owner operator, another owner? And what, or was it a strategic? Going through that whole process of finding buyers and deciding, how long? There's so many questions I'd have for you. How long does that take? How do you take somebody through that? And then here again, we layer in stuff's happening in the world. There's uncertainties and headlines going on. It's got to be emotional.
It is emotional. Part of the job an intermediary does is try to keep that emotion under control for their client. That if you get in someone, we just had this happen on a company, and I wasn't the one working with talking to that particular buyer, but he sends in what's called an indication of interest, which is not an offer, but it says, this is what I think I'm going to pay. Mm-hmm. Often it's a range. This was an exact number, and it was way off the mark. And do I share it with my client? I said, we got it. We had someone do this indication of interest. Here's the amount. Do you want to see it? They said no. Mm-hmm. If they said, I want to see it, we show it to them. Mm-hmm. But we want to keep that emotion off to the side for them, that we can handle that as much as possible. And I prefaced it with the way this person handled it and didn't even want to talk to you before sending this in is a little unsettling to us.
Mm. The way the prospective buyer showed up in that was raising some flags.
And this is not a 40 to 100 some million dollar deal where all the numbers come out first. But when you're talking with, this is someone's business legacy. Mm-hmm. They want to make sure they're selling to the right buyer, as we talked about.
Yeah. So I can imagine businesses in the trades. So home builders, let's just say home builders in 2009. Somebody's like, so many home builders and contractors, they got wiped out.
Yeah.
In that, if someone were to come to you in a directly impacted industry, or let's say it's it's that first quarter 2025, and trade wars are tariff wars are happening, and they're an importer. What do you say to that guy? John, I need to get out. I need to sell my business today.
I say, talk to OneAccord and get these things figured out, and then we can sell it.
Okay.
How's that, Nick?
Okay. I mean, it's
yeah,
fair.
It is.
So
It is a tough one when there's something directly affecting the business, and in these days, it's tariffs on, tariffs off, tariffs on, tariffs reduced for you, but not for the other person, other country.
How do you make heads or tails?
Yeah,
in addition, not just tariffs, but in the first quarter of the year, significant changes to government spending, right? Many contracts have been canceled. Billions and billions of dollars of contracts canceled. And that's a headline. And, people can make of that what they will. I want to stick to the economics of it. Those contracts paid firms to do work in industries, and those revenues are gone. And those firms, I look at some of the big consulting shops like Deloitte and McKinsey that had massive consulting contracts with the U.S. government that are gone. What do we do?
Well, that's an interesting scenario, because we all know that there was no research done to what contracts to cut. It was just like, here's the machete, cut here. In the article I wrote, that's going to be on both of our blogs, I talk about how politicians, and especially most presidents, really don't have a clue on the economy or economics. And you think about it. I think about, not even beyond my lifetime, is there weren't too many. I think maybe Reagan and Clinton. Nobody, people don't want to recognize this, but Clinton reduced federal government employees by almost 500,000. Al Gore was in charge of it. It was bipartisan, I believe. But it took them 6 months to decide what to do. They didn't just come in 6 days and say, cut all this stuff. It's got to be wasteful. And then they're going to realize, you talk about the big consulting firms, but when they came in and started firing indiscriminately air traffic controllers, well, do you really want to get on a plane when they're short air traffic controllers?
Yeah, I am. I'm just thinking about on the other end of the spending is the receiving. And if there are billions of dollars of government spending being cut, that means billions of dollars of revenue for a lot of firms. And
those firms' employees are not going to be spending the money. They're not going to be taking that vacation or buying the new car or the new TV, because they have to buy groceries and they have to pay the mortgage and the utility bill.
So I think of, we've got folks that have military backgrounds, and as we think about who might need some assistance right now, because listen, we can serve companies in times of economic exuberance, right, and in times of economic despair. If everything's going up and to the right and firms are growing and they need to figure out how to more efficiently service, grow more revenue, open new stores, grow the top line, we can help that. Or if it's the turnaround scenario, so we're well positioned to serve clients in up or down markets. Right now, I'm thinking of who is negatively affected. Who are the firms? Suppliers in the military, for example, and what do we do if there's a firm that makes products that are sold into the U.S. government? Then nope, we're not buying those anymore. They're going to have to pivot. So I guess it's really just a customer concentration concern
or industry concentration.
Industry concentrations.
But the company that makes just call it a widget, it could be these microphones. And look at these things and imagine how many different parts are inside of here. Where did they come from?
Mhm.
And if they came from China and they're getting 100% tariff, what's it going to do to the cost of this microphone? Well, it's not going to raise it. It's not going to double it because it's just a small part. But if enough
Right.
small parts are in there, and then are people going to buy them? Are you going to say, no, I think this microphone, I paid X hundreds of dollars for it. Now it's 50% more. I don't think I'll replace it. We'll go with what we got.
Yeah.
And that's a trickle down effect there.
Well, and it then just creates both the problem and I would say then the opportunity for that firm. The problem is we're not going to be able to sell these things at this price if the component parts are there and the market's not there. So what's our next opportunity? How do we solve for that?
How do we solve it? A good example, the Wall Street Journal had an editorial the other day on the tariffs, and Wall Street Journal is not bullish on tariffs at all. And they used an example of small business chocolatiers, people making high quality chocolate.
Mm-hmm.
And they pointed out, they put tariffs on all these countries, and they used Madagascar as an example. And they said, well, chocolate grows between 20 degrees each side of the equator. That's where chocolate's grown. You want to have chocolate, you can't say we're going to grow it in North Dakota or even Texas or Florida.
Oh,
it doesn't grow there. The cocoa plants
yeah.
go. And you're talking to some of these owners, and I remember a couple of them. One of them, pretty high-end stuff. When the lady who owns it says, well, if we have to pay these tariffs, the cost of our chocolate bar will go from $10 to $12. That's a pretty expensive chocolate bar.
Yes, it is.
And another lady made bonbons or something. She says, I can't see charging more than we charge now. But what are we going to do?
Yep.
So it really hits the small business.
It does.
They don't have the flexibility, and they can't go in and
they don't
buy up supplies.
They don't control enough of the market to then set price and just like Apple can actually set the market for iPhones.
Yeah.
Like the next one that comes out could be $2,000 and people are going to raise their eyebrows and then they're going to get over it because that's just what it is.
Yeah.
Good. The thing is, I'd say irrespective of whatever, thoughts or opinions a person has on, good, bad, there are effects of the policy decisions. And those effects are what we deal with. It's what we see. So it could affect the valuation of a company. It could affect the price somebody's willing to pay against that value. People might pay more or pay less. Could affect profitability in the company, operations. The externalities do affect everybody.
Yeah. And then what happens when it gets back to quote unquote somewhat normal? I mean, eggs are a perfect example. We've seen what's happened to the price of eggs. And there's a lot of, does it bother me and our family? Are we not going to eat eggs for breakfast as much? No, because it's not that big a part of our budget. But I think you could take someone that says, well, we're both working middle-class jobs and we got 3 or 4 kids. And, we're going to give them cereal instead of eggs. And when the price of eggs comes back down, they're going to say, let's stick with the cereal.
We probably consume 4 dozen eggs a week in my house.
Yeah.
Yeah, we do. We love eggs. And my father-in-law has chicken, so that's good. But so here's the thing. A client that is in, they're in the farming, they're in the food space. And they buy raw goods from local farmers. So their inputs, and they charge more.
Yeah.
So they might make a higher end, more exclusive kind of product out of locally sourced, economically sustainable. So the idea of, kind of the early 2025 economic policy is to get more locally sourced, support the farmers. Let's just say it that way. Okay. Great. The local farmers really love that idea. Then we layer on tariffs. The fertilizer and chemicals that the local farmers use are purchased from overseas. So the cost to produce whatever it is, let's just say grain, the cost to produce the grain goes up because of the inputs that the farmer has. If they don't meet, so then in addition to that, the price of the grain is falling, and there's some impact there. So cost of inputs goes up, the cost of the commodity comes down, and we can say on one hand, well, that's really good. That's deflationary. The cost of flour, the cost of grain is coming down for the consumer. Cereal is going to be cheaper, say it that way. But the cost of the fertilizer goes up. So then these small farmers get pinched. And
some of them do. I'll give you the contrary to that.
Yeah.
If what you just said happens, the organic farmer is saying, oh, now they're going to have to be more price competitive with me because I don't use that fertilizer that's imported.
So the big big conglomerate.
But you were talking about the small local farmers.
Yeah.
And
so those,
they're never going to, organic farmers, local farmers are never going to compete on price with ConAgra.
Right.
And the others.
No. They're going to be, they're going to be $13 a pound versus $3 a pound of flour, whatever that looks like.
I know when I go to the farmers markets in the summer. Yeah, it's not what you would pay at Fred Meyer or Safeway.
It is not.
But it's completely different product.
Right. So the kind of the second and third order effect of this is that when the farms get pinched, then they might exit.
Mm-hmm.
And there's private equity money sitting on the sidelines looking at these opportunities to then roll up smaller farms. And, some of those second and third order effects are that we actually lose, we don't achieve the objective that was set out for us. Coming back to that, the local farmer, that small craft farmer, the local organic, right? They're going to be impacted by externalities that might even include weather, that might include a dry season, right? So I guess the point here is the only thing constant is change.
Agree.
This too shall pass. And even with those two cliches in hand, it's not always easy.
It's traumatic.
Yeah.
And it's more traumatic if you're depending on stuff coming in from certain countries right now. And you can't even plan because the tariffs could be on and they could be on or they could be off.
Yeah.
And the owners who say, well, they think these companies that government in China is going to pay these tariffs. No, it's an American company buying the things from their factory in China, and Chinese aren't going to pay these tariffs. The Vietnamese aren't going to pay these tariffs. It's that company that's bringing them in, whether it's Nike or a small local business.
Yeah.
I mean, I know someone who has they do tombstones and monuments for cemeteries, but he would buy his stone from India and China. It's a small business doing, 7 figures a year.
Yep.
Making a nice living.
Yeah.
But it's going to affect him like it affects the big players.
So in the first half of 2025, the early first quarter, second quarter of 2025, there's economic uncertainty that comes from policy decisions. A few years prior, there's economic uncertainty that comes from a worldwide pandemic. A decade prior, there's economic uncertainty that comes from the global financial crisis and, banks doing a whole bunch of risky stuff. 10 years prior to that, there's the dot-com burst.
With 9/11 on its heels.
There you go. And so, I mean, we can keep going back in time and we can find it. In in the middle of it, the way out isn't clear for a lot of businesses. Like sometimes in the midst of, like you say, tariffs on, tariffs off. What's the policy going to be? We don't know. It's unclear. When COVID shut down markets and cities, is it going to be 2 weeks? Is it going to be 4 weeks? What's going to happen? It's in the midst of those times of uncertainty that fear is at its highest. And yet we can look back and say, well, this too shall pass. I worked with a guy, he had a great line. He probably got it from somebody else. So the only way out is through. The only way out is through.
And that comes back to doing things you would normally do. And if you're fortunate enough to have the working capital to keep doing those things, we just hired someone to put together called a blueprint for social media kind of marketing and that, because, we want to make sure we're doing it right. And, not doing too little, too much, putting the right things out, having the right connections on that to, whether it's hashtags or whatever else, keywords, etc. Because that's where people find a lot of stuff these days. Is they they go on LinkedIn, and my world, probably yours too. LinkedIn is the most viable for getting things out that people we want to see what we put out actually see it.
Yeah,
and you have to do it right, but you have to do it.
Yes. So the only way out is through. There are some basic block and tackle things, the X's and O's on the chalkboard in the locker room, if we will, as we're game planning, marketing, sales, operations, finance. Address those things, have a plan, and then it just is the case that stuff is going to happen.
Well, you missed one thing.
What's that?
Implement the plan.
Yeah.
Do you know how many shelf plans there are in offices?
Too many.
Yeah.
Too many. Yeah.
And I know you meant when you said to do a plan, it meant create a plan and do it. But
we're in the business of implementing the plans, not just writing the plans and putting it on the shelf. So that for me is that's a given. Yeah. Is there anything that just in this conversation that we haven't yet covered that's important?
I think we've really touched on a lot. In the article that I wrote, I wrote about things as owners should do, and it's we talked about those: good financials, owner dependency, get rid of other dependencies like customers or a key employee. And if you look, there's a lot of turmoil, but if you can grow, keep growing. Don't coast.
Yeah,
because you can only coast downhill.
Good point.
And so if you say, well, we've been the same for the last 5 years, it means you're going down.
Yeah.
Because your costs of every other things are going up.
Right. And like you just alluded to, you're putting some energy into marketing and growth in a season that, just consistently.
Yeah.
Throughout. Yeah.
It's one thing you have to do. A thing I learned a long time ago in any kind of advisory business is how much marketing you need to do. And I used to teach 2 to 3 times a year class at the local SBA office on growing an advisory business. And I would, I put up a slide right near the beginning, and I say, it says, you are in, and there's a blank. And I'd ask them, and they would say, well, we're in the helping companies grow business, or we're in the green construction advisory business. And I say, no. I click it. You're in the marketing business. Until you have a client, you are marketing 100% of the time.
Yeah.
And when you do have a client or two, you are client work, and the rest is filling to 100% is marketing time. And when you feel you have a full complement of clients, you're marketing a quarter to a third of your time. And that could be writing an article, doing these podcasts, going to a networking meeting, meeting someone in a referral relationship that can send you potential customers. And, you have to keep doing it. And, and you have to, therefore, just like any other business, advisors have to charge enough that they can do that marketing instead of saying, "Oh, I got to be with the client all the time."
Yeah.
You'll never get better clients.
Yeah.
And the same goes for a widget maker. They got to be doing things to sell more widgets and different kinds of widgets, and finding out what their customers need. And yeah, I was with a client yesterday in their factory, and you're saying, "Yep, we go to their." One of the things they do is they say, "We make this for this customer, and then we find out what else could we do for them once we're in with them." That's marketing.
Yep. That's it. So good. John, thanks for hanging out, having a conversation.
It was great.
The first of many.
First of many.
All right.
And we will do this again in the next month.
All right. Thanks, John.
All right.